Welcome to Market Call. We are talking real estate with Andrew Moffs of Vision Capital, 1-855-326-6266, or you can email him, marketcall@bnnbloomberg.ca. Andrew, thanks very much for joining us.
Thanks for having me today.
Just remind us, you're okay with real estate equities, REITs, across the real estate investing spectrum?
Correct. Anything publicly traded that touches real estate, that's what we do at Vision.
Oh, okay, no problem. What's the latest that's catching your eye? We heard more evidence yesterday that condo rents in Toronto are collapsing, down about 17% in the past year. What are the trends in real estate that are most interesting you right now?
Well, you pick on that trend. For us, we look at the condo market and we compare it to the real estate that's available in the publicly traded real estate market, and it's quite different. And for us, we look at a company like Canadian Apartment REIT, and they're more focused on that upper middle tier of the market, more suburban, that isn't competing with the suburban rent, the condo rent. That condo rent's being affected by a real shutdown in population growth in Canada, but we view it as temporary. The government's said we're going to see a return to immigration, and the return of both immigration as well as foreign students will make a big difference in the condo market downtown, which has really filled that rental supply. In the meantime, we think the Canadian Apartment REITs, specifically Canadian Apartment REIT, is well positioned, and they really don't compete in that upper end of the market.
That's interesting. Yeah, it's a different world out there. What about retail? You have been cautious on many areas of retail. What trends are you seeing? I mean, is there a prospect for these retail properties to reinvent themselves where necessary?
Absolutely. I think that's always been the trade, is that retail properties need to continually reinvent themselves. That's the constant in real estate, is change. What I would say, though, is first quarter is going to be very choppy. We've gone through the bankruptcy season. We've seen more store closures this year than the previous year. And what's going to affect the retail REITs is, they had this rent holiday with their tenants. Now that they have to get back to the table, nothing has really changed for the fitness operators, the theaters, et cetera. So retail will have to continue to invent itself. It's going to take a lot of capital to do so. And from a top-down perspective, we continue to stay away from sectors like retail. But on the flip side, who's the winner? It continues to be logistics, industrial, warehouse, real estate. That's where we're primarily focused because we see the growth there. We haven't seen the consumer stop shopping. We've just seen the consumer shop differently. And fulfillment online through warehouse is where we are really focused on at Vision.
Let's leave it there. We've got Andrew Moffs taking your questions today on real estate stocks and REITs, anything connected, publicly traded, connected with real estate. Andrew, are you okay with real estate service stocks like a First Service or something?
Sure. Yes, yes, I am.
Okay. Good stuff. 1-855-326-6266. Carolyn has sent us an email, wants to know about Northwest Healthcare Properties.
So Northwest Healthcare Properties is definitely situated in the right area of healthcare today, focused on hospitals and medical facilities globally in areas like New Zealand, Australia, Brazil, and Europe, and with their legacy portfolio here in Canada in the medical office side. Today, the stock actually trades at a nice premium to its intrinsic value. So, as I said, they've been well situated from a top-down perspective. It's where you want it to be. At this stage of the game, they're probably better off looking to the public markets to issue capital, take advantage of their well-priced stock, and continue on the acquisition side. And as they continue to build out their asset management side, they should be in a good spot. So if you own it, I continue to hold it. I think they're in a good spot today.
Okay. Gord has sent us an email, wants to know about MINTO REIT. And can you remind us, Andrew, what kind of an outfit is MINTO REIT? What properties do they have?
MINTO focuses on the apartment sector in Canada. They have a concentration in Ottawa and a big holding here in the GTA. as well as across other markets here in Canada. They've expanded to Montreal as well and to Alberta. They, of all the apartment REITs, they've been, really hurt because of their high-end exposure. We talked about at the top of the show, high-end exposure, downtown areas. You start to compete a bit more with the condo stock, and especially units that were leased out on Airbnb and other short-term rental outfits. We think Minto is a cheap stock. We think highly of management. This is one of these names that should do well in a V-shaped recovery. Like I said at the top of the show, if we see a quick return to immigrants as well as foreign students coming to Canada, the stock should do well. So we think it trades at a discount to NAV. We appreciate the short-term concerns, but if you own it, I'd hold it and look for pullbacks to buy.
Stephen in Calgary is on the line. Go ahead, Stephen.
Yes. Hi there, Andy. First-rate show. Andrew, I wanted to get your thoughts on the management and assets of KILLAM Apartment REIT, as well as what you think of their earnings going forward in 2021. Thank you.
Thank you.
We think highly of KILLAM's management team. They've been there since inception. They've done a tremendous job of growing that REIT with a focus on the Atlantic Canada and a nice expansion westwards as they've grown into Ontario markets and all the way out to BC and Victoria. KILLAM, I think, has really shown itself through the pandemic as a very stable operator, given the markets that they're in. Continue to have a nice mark-to-market. Continue to have a very nice value-add strategy where they go into their units and they upgrade the units and are able to get a nice return on their capital. So very steady growth. Its stock's rebounded nicely off its lows, as it should have. And the growth won't be quite the same as some of the other REITs, but steady is good in this environment, and I'd continue to own KILLAM if you own those units.
Okay, Andrew in Toronto, fire ahead, please.
Hello, Andy and Andrew. I'm calling on digital realty and the data storage space. If you could just go in depth on that, thank you so much.
Thanks.
So Digital Realty Trust, ticker DLR in the United States. This is one of the original data center REITs in the U.S. It's a big daddy market cap. I'd venture it's probably over $40 billion today. They focus on data centers in the key markets globally. From a secular perspective, this is a theme that works as, data consumption has only increased as, just think about us all working from home and accessing the cloud. It's been a tremendous play on both internet usage, mobility, as well as cloud services. Where the sector's got into hiccups in the past has been on the supply side, just like any other business. It's about demand and supply. I talked about demand, and supply has been an issue from time to time. When there's too much supply, the tenants have power versus the landlord. I think today it's a much more balanced situation. The stock trades at a nice premium to net asset value. Hence, it's not something we focus on at Vision. We're always trying to find discounts in the market. But as a long-term secular growth rate, I think it should do well, but for periods of time where you become oversupplied. So I think today it's in a good spot, trades at a premium. You might look to trim on strength and continue to hold. Mary
in Kingston, Ontario. Go ahead, please.
Hi. My question is about Plaza REIT, and just if your guest would recommend or not. Thank you.
Thanks.
So Plaza REIT's a smaller cap retail REIT focused in Atlantic Canada as well as Quebec, where they're based. Very strong management team, been very adept at buying undermanaged real estate and fixing it up. This is a much tougher environment for them to be operating in, and just like anyone else. And if you have to own a retail REIT, you could own this one, because what I do like about it is that they have a very high credit tenant base. Think pharmacies and grocery stores. But at the same time, it's a very tough leasing environment, and you can just see what the stock price has done as a result. People have questioned the resiliency of brick and mortar retail. I think Plaza skews on the better end of that, given the types of credit and necessity-based retail that they have. But if you're looking for better growth, I would look elsewhere. That's I guess the bottom line with Plaza.
Okay, let's take a break. Andrew Moffs of Vision Capital is taking your questions on real estate stocks and REITs. 1-855-326-6266. Arthur in Vancouver, go ahead, please.
Hi, my question's on BPY, Brookfield Property Partners. Brookfield has got a proposal to take it private, but actually what they're offering is less than what's selling at right now. So I'm wondering if I should just pull the trigger, sell it, and either split it between some BAM and something like WPT. Thank you.
So yeah, it's a great question. BPY is the subject of a takeover from its parent company, Brookfield Asset Management. Brookfield Asset Management has a very long track record of buying out its subsidiaries and a very long track record of increasing its bid after the initial bid gets reviewed by the independent special committee that's usually established. That's what the market is handicapping right now. Just take a step back. BPY is trading at a very wide discount to its intrinsic value, at least the IFRS valuations that the company has put out itself. Forget about what analysts write or what I think. Thus, Brookfield Asset Management is really taking advantage of this at a very opportune time. Thus, the market expects a better price. This is the risk reward you have to decide yourself. Do you want to wait and see, and if you get the bump in the bid, do you sell in the market today, move on to something else that perhaps has greater upside? I really liked your suggestion in terms of WPT REIT. We think extremely highly of that stock. It's one of our holdings at Vision that's focused on the industrial warehouse sector in the United States, but listed on the TSX, ticker WIR/U. So I personally, if I owned units of BPY today, I'd probably move on, unless I'm an investor that looks into risk arbitrage opportunities and is comfortable with the risk reward scenario. Brookfield Asset Management is a good option as well. We always think you should always follow the cash flows, and Brookfield, as the external manager of BPY, was the beneficiary of all those cash flows. So nothing wrong with owning that stock, but I see more upside today in WIR.
Okay. Chris in Hamilton, Ontario. Go ahead, please.
Gentlemen, thank you for taking my call. I'd like Chris's view on Granite. Does he own it, and I guess would he buy it at this level, or would he wait for a pullback? Thanks.
So we own Granite in our funds today. It's previously been a top pick of ours, and we've continued to hold it. Think very highly of the management team. We like the portfolio exposure. It's a balance of warehouse in Europe, in the United States, and in Canada. They've done a great job of diversifying away from its largest tenant, Magna, which we actually think the valuation of those properties leased to Magna have a lot of upside. They're strategic manufacturing facilities for Magna, and we think are actually hidden value within the REIT today. What we like about Granite is that it has a good cost of capital. It's been able to grow effectively and take advantage of this the trend that I talked about at the outset. Warehouse facilities are in demand because at the core, the underlying users of that space are reliant on e-commerce, and us as consumers continually moving our purchases online and being delivered from the warehouse. So if you own Granite, I think you're in a good spot. I actually think it's attractive at these levels. We think there's quite a bit of upside as we see a nice mark to market in their rents, and we see net asset value continue to grow on an annual basis for this REIT for the foreseeable future.
Okay, so that one getting the nod of approval. The yield not huge, only about 4%, it looks like.
Yeah, and that doesn't surprise us. We're total return investors. The yield is usually the last thing we look at. Of course, we care if it's sustainable, but typically the higher the yield, the less sustainable, as you've seen in retail REITs recently. For us, it's all about the cash flow growth that generates the net asset value growth. And so long as the enterprise is increasing in value, we think the share price will follow suit.
Jacob in Mississauga, Ontario. Go ahead, please.
Hi, Andy. This is my first time calling, so thank you very much for having me.
Good stuff.
Big fan of the show.
Thank you.
Thank you. I would just like to ask for Andrew's position on Morguard REIT, your thoughts on that. Thanks. Go Leafs, go.
Thanks for calling, Jacob.
Yeah, go Leafs, go. I agree. So MRT, Morguard, this has been a tough stock to own. It's controlled by Morguard Corporation, MRC. It owns retail and office and a little bit of industrial, but that retail has really been the Achilles heel. Owning enclosed shopping malls is not where you want to be in this environment. And unfortunately, they don't have the cost of capital to do much about it, but for borrow more capital and use as leasing costs against either tenants renewing, going dark. And so thus, this is a REIT that's, it's deep value for sure. But you have to ask yourself, what's your upside downside from here? We tend to shy away from these names where we don't necessarily see the catalyst. And part of that is predicated on the top-down perspective. We're not buyers of office today. We're not buyers of retail today, particularly on the enclosed mall side.
Okay, we're going to take a break. We're going to have a look at Andrew Moffs' past picks next. You're watching Market Call. Let's get to Andrew Moffs' past picks. I'm having a bit of trouble with my computer system right now. Sorry, BSR REIT, HOM-UN. Would you buy this one again, Andrew?
Indeed. For us, this continues to be a top pick at Vision. It's hard to believe when we were last on the show, we were sitting in the eye of the storm, so to speak, back in March when we recommended this one, and you think back to what's happened. BSR REIT, they're focused on Sunbelt apartments in the United States, focused on Texas and Oklahoma City, between Austin, Dallas, and Houston and Oklahoma. It's called 90% of the portfolio, workforce apartments. And they're affordable apartments, and this REIT has done very well navigating through the pandemic. They've actually had better than their peers in terms of operating income growth, about 5% versus peers probably in the 3 to 4% range. But the point is, you look at the valuation of this REIT, the stock price is basically hasn't done anything, if not gone down. Meanwhile, apartments in the private market in the U.S. Sunbelt have actually increased in price since the pandemic has begun, as we've seen the huge population growth from the coast and urban centers to cities like Houston, Dallas, where you can get a lot more space and have a cheaper cost of living. So we think BSR is a cheap stock, well situated. We're buyers of this stock today.
Why has it lost altitude over the period, Andrew?
Well, we always find this, and when you have companies that own U.S. real estate exclusively but listed on the Toronto Stock Exchange, they don't have the right following, and it's a perfect opportunity for funds like ours to take advantage of. What you find is that if you're an investor in the United States and you're well-versed in the positive dynamics of the U.S. Sunbelt, you invest in the U.S. listed REITs that are listed on the New York Stock Exchange. Canadian investors, they know what they know in their backyard. They don't really appreciate the value of apartments today in Austin, Texas. Well, we do. And I think that's it's an arbitrage we've been long taking advantage of at Vision. And eventually the market gets there, whether it's the earnings growth simply justifies the stock price and people all of a sudden come around to a smaller cap name, or every now and then there's a privatization that closes that gap.
Tricon Capital Group, nice return on this one. And this is another U.S. real estate player, a return of 17%.
Yeah, Tricon's been one of the largest positions in our fund. We think highly of their strategy. They're focused on single-family residential in the United States. They're buying single-family homes and renting them out en masse. They've used technology adeptly to manage effectively, and as a result, we've seen margins go higher. We've seen valuations go higher. What we like about this sector, you have the ability not only to buy homes on a cap rate basis, meaning buying homes and earning a first-year yield and call it the 5.5–6% range, you then have the benefit of all these homes in aggregate benefiting from just simple home price appreciation in the United States, which has been double-digit. So we see big runway for growth for Tricon, hence it remains one of our top picks at Vision. Just yesterday they had their investor day, and you could come up with math that would suggest there's another $5 of runway in this stock based on some of the initiatives they outlined, including a mark-to-market in rents. They think their units are 9% under rented, and so just that alone gives you a lot of that upside that we feel pretty good about at Vision.
Okay, so you'd stick with that one. Your final name, let's get to that. Hang on, I'm having trouble with my computer once again. Sorry. Your final name, StorageVault Canada. Would you buy this one again?
Indeed. StorageVault's focused on the self-storage industry in Canada. That market is a little bit behind the United States in terms of its development. It's a good thing. We want demand to exceed supply. And when there's only 3 square feet per capita versus 8 square feet in the United States, we think there's a big runway. StorageVault's 3 times the size of its next biggest competitor. It also uses technology very well to manage its facilities. Its valuation, it's still cheap. You look at what's going on in the United States. There have been several large transactions that have occurred at cap rates that are lower than where StorageVault is trading. When you have a lower cap rate, it means the values are higher. And again, this is the market leader. And you think back, we made this recommendation back in March, and I talked about brick and mortar and retail. I mean, at the end of the day, this is a consumer business, people moving in their stuff. It's hard to believe how well both the company's operations have done and the stock price has done. But then you take a step back and you think it's not that surprising. This is a recession-resilient business, and I think the pandemic has only proved that. So we continue to own StorageVault, think it's cheap at these prices, and see a lot of upside ahead.
Okay, we are going to take a break. Andrew Moffs of Vision Capital is taking your questions on real estate stocks, REITs, 1-855-326-6266. Andrew Moffs is taking your questions on real estate stocks. Joy in Markham, Ontario. Go ahead, please.
Good afternoon. Thank you for taking my call. My call is on Summit Industrial REIT. Andrew, could I have your opinion on this, please, from growth and value point of view? Thank you. I'll hang up and listen to you.
Thank you.
Sure. We like Summit. For sure, we like the sector they're in, industrial real estate. It's the right question, growth versus value. I'd say today the value isn't there. They traded a healthy premium to their IFRS valuations, a healthy premium to the street net asset value estimates. And perhaps that's okay because the growth side has traditionally been there. They are in the right markets, a nice concentration in the GTA, where we've seen rapid increases in rents, and that usually portends a nice increase in net asset value over time. I think today the stock has really captured a lot of that upside. It's fairly valued today. I'd hold it. I really look for where I like Summit is I look for pullbacks to take advantage of and buy the stock. But today I think it's a pretty healthy valuation.
Okay, so it's not calling out to you in value terms right now. Craig in Fredericton, go ahead, please.
Take my call. Just have a question in regards to RioCan. I know they cut their dividend recently. Just wondering your thoughts on their positioning going forward, whether they're trying to take advantage of the market in Toronto. Just your thoughts. Thanks.
Thanks.
I like the way RioCan is positioned to take advantage of opportunities in the future. They have a nice development pipeline that's in the core nodes of the major centers they're in. Thankfully, they really did a great job of reorienting their portfolio over the last several years to focus on the major markets in Canada, whereas traditionally they had been more suburban. So they have great development projects. Unfortunately, a lot of those projects will be dwarfed in the interim period by their massive real estate holdings, where they will have a lot of blocking and tackling to do and release space and be competitive on rents. So far, they've done a great job, and you've seen the stock bounce off the bottom. We thought it would. It's always a stock we like to trade because we do see the value. We think management is strong, and they're doing a good job. But today, there's some question marks, and then if you marry the question marks with the valuation, in real estate terms, they're trading at an implied cap rate of, call it 6%. Is that cheap enough for retail real estate? And when you have question marks on the horizon. So today, it's not the buying opportunity that it was for sure. And I think there's still volatility ahead as we get through fourth quarter earnings into the first quarter. And I think you might see better opportunities to trade this stock. And hence today, I shy away from owning RioCan at this given time.
Okay, not calling out to you. Mark in Ottawa, go ahead, please.
Sandy, I'd like to ask your guest about American Tower. I'm looking at that stock. It's just a great nuts and bolts play on 5G. And I know they carry a bit of debt and stuff, but in today's 1% interest, like on their loans, I'm not too concerned about that. I just see this as a solid stock going around 20% a year. What is your thoughts? Thank you.
That's an astute comment. I'd agree. Today, low leverage or high leverage is perhaps not necessarily a terrible thing. Regardless, American Tower has a tremendous balance sheet, so they can deal with the higher debt that may be perceived. This is a very big company, over 100 billion market cap. They own towers globally, and as the caller said, they benefit from the future rollout of 5G. I'd caution that rollout isn't as smooth as one expects. What has come with the rollout of 5G is consolidation on the tenant side in the United States, and as a result of the relinquishment of certain towers. And so, American Tower, Crown Castle, et cetera, they've had to work through some turnover on their towers. But again, longer term, they're very well situated as we all continue to consume data, and 5G will be an integral part of that. The company trades at probably 30 times cash flow today. That's expensive, and it trades at a very healthy premium to net asset value, because at the end of the day, this is just a tower on a pad. So as a longer term play, I'm not too concerned about it, but from a value perspective, we're not there.
Okay, not appealing to you right now. Krista in Burlington, Ontario, go ahead, please.
Hello, gentlemen. I would like to ask you about the real estate stock ARTIS. It's been quite flat for quite a while. I've had it a number of years. I'd like to know the future for the next 3 years. Thank you.
Thank you.
So we've seen some turnover, say lightly, of the management of ARTIS. They were subject of some activism, and today the activists now control the REIT, and we're waiting to hear their capital allocation plan in terms of how they are going to surface value for the REIT. ARTIS owns a collection of assets across retail, office, industrial, and across North America. So there's no obvious solution. Often you find when REITs trade at a discount to net asset value, you can privatize them, find a buyer to close that gap. I don't think there's a singular buyer for ARTIS when they own office buildings in Madison, Wisconsin, and industrial real estate in Phoenix, Arizona, and retail in Winnipeg. So there might be some value there. I'm not sure what the plan is for management. I think the stock has rallied off the bottom, and given the risk reward today, and also one thing people have to remember, there will be friction costs. So what do I mean? If you're able successfully to break up this REIT and sell off its parts, I wonder what the tax ramifications will be when that occurs. So there may not be the upside. I've heard numbers of $14, $15, but structurally, I just wonder if one is able to get those numbers on a sale. So today, it's a hold. At the end of the day, I'm not too concerned about some of their holdings, but we tend to shy away from office and retail generally, and this is the majority of what ARTIS owns.
Okay, we'll be back with Andrew Moffs taking your questions on real estate stocks. 1-855-326-6266. Michael in Vancouver wants to know about the REIT ETF. Go ahead, Michael.
Andrew, good morning, and thank you for taking my call. Hey. Andrew, I was a little light in my portfolio in this area of the business, and I decided to purchase XRE about 5 years ago. It was doing just fine until the COVID hit, and basically is down for about 20 to 25% off its highs, partially, I guess, due to its retail and office space holdings. I was thinking of selling that because I'm not quite sure if the bounce back is going to come anytime soon. And I just wondered what your thoughts were on selling that and possibly buying a very small basket of REITs, possibly your top picks, about 3 or 4 REITs, and then just doing that just to do it. I do like the dividend that it pays, but again, I'm not quite sure if the rebound is going to hit this area of the business. I'll hang up and listen to your response. Thank you, lads, for taking my call, and have a great day. Bye-bye.
You too. Thanks.
Yeah, I think you're asking the right question. I personally would move on from the XRE today. I always say if you need quick exposure in a certain sector, great. You can purchase the ETF, but there's something to be said about active management. And I'll give you a great statistic in real estate specifically, because everyone has this perception that the word REIT means everything trades the same. But every real estate sector is very different. And the stat is that if you look at the top quartile performance of REITs and the bottom quartile performance of REITs, there's a 48% spread in performance annually for the past 20 years. So with that said, I don't think you're going to be able to capture the upside today, taking an average of 15, 16, however many stocks there are in the ETF. I think you're far better off concentrating on the winners and avoiding the losers. So yes, I love the idea of purchasing REITs in the residential space. Canadian Apartment REIT is a great choice. BSR REIT, ticker HOM, which I talked about, is a great choice. Looking at industrial warehouse REITs, WPT, which we talked about, Granite REIT. I think if you concentrate in those sectors, you're going to be better off. And then if you can do the job of going bottom up and finding the companies that trade at discounts or have the growth, you're going to be even better off. And I think that's the path one should take today, especially in this market. There's a lot of caution out there, a lot of volatility, and it's really about active management today.
Okay, no problem. I guess, Ed, but any active manager is going to be cool on the idea of buying a REIT, a sector-wide REIT, I guess, Andrew.
Indeed, but it comes down to, I mean, I'm just quoting you statistics. I mean, it just comes down to the math. Yeah. If you can just put yourself, if you forget about giving your capital to an active manager, if you can put yourself in a better position than the average when you do that, and if you just simply follow those trends on a top-down basis, you're going to put yourself in a far better position when you can, ask yourself the question: am I better off owning warehouse today or brick and mortar retail? And I think any novice investor could probably come to that answer, and I think you're already going to be ahead of the game.
Okay, we've got Curtis on the line from Calgary. Fire ahead, Curtis.
Thanks for taking my call. My first time calling in. Andy, I wanted to ask Andrew here about SPG, Simon Property Group. Are they in a better or worse position based on their size right now? And what do you think the future holds for them? Thanks, guys.
Thank you.
That's a great question. Simon Property Group's the largest owner of enclosed malls in the United States. At one time, they were the largest REIT in the United States. It's hard to believe how much they have fallen, but they're a solid company, solid management, good assets, some of the best malls across the United States, whether it's now Short Hills Mall in New Jersey, whether it's Town Center in Boca, et cetera. They have the right assets. But size isn't necessarily the answer. I think back to the financial crisis in 2008, 2009, and the biggest concern was, well, look, the debt markets are closed. How could one ever, then the fallback in real estate was, oh, well, let's just get a mortgage. And then people were thinking, well, how can one ever get a $300 million mortgage today? So sometimes size benefits you when scale is a good thing. Sometimes size hurts you when the financial markets are closing. Simon has rebounded nicely off its bottom, excuse me. It's part of that V-shaped recovery trade. It's getting much closer to net asset value than any of us had expected. Street estimates are probably in that $110 range, and we're flirting with $100 yesterday. So today the risk reward to me is not there for Simon Property Group, but I do think highly of the REIT, and I think it's just it will survive. The rest of the mall REITs may not, but Simon will definitely survive.
Glenda is calling from Prince George, BC. Go ahead, Glenda.
Good morning. Thank you for taking my call. Andrew, just wondering your opinion on the U.S. REIT Income Realty Corp. And what is your opinion in getting into any of the U.S. REITs in the current market?
So Realty Income, the ticker's the letter O. This was one of the original monthly dividend REITs, and they were able to pay a monthly dividend because all their leases are net leases. They're long-term leases. They're single-tenant real estate. And they're just able to have a predictable cash flow. They are so large today that no single lease could hurt them. We're talking $2, $3, $5 million properties, $10 million properties when this is a multi-billion-dollar REIT. So they have a well-diversified credit base, which I like, which is important when you're underwriting net lease real estate. At the same time, one has to be careful about owning net lease in certain parts of this cycle. And what do I mean? These are typically higher yielding, higher dividend REITs, which at certain points is attractive, and today that might be so. But if we go into a higher interest rate environment over time, it typically acts as a headwind for the actual stock. So Realty Income today, if you own it, I continue to hold it. I don't see any credit issues with their specific tenant base because, again, they're well diversified and typically have investment grade tenants. And I do like some of their expansion, which they've done internationally into the United Kingdom. So I think from a geography perspective, you're also well balanced. So as it relates to Realty Income, I continue to hold it.
Okay, we are going to take a break. We're going to get the top picks from Andrew Moffs right after this. Your first idea, Andrew, BSR REIT.
Yeah, so BSR we talked about earlier, U.S. Sunbelt Apartments, a way to diversify yourself away from the Canadian markets, but own a stock listed on the TSX. We think it's cheap. We see a lot of upside with this REIT. They've done a great job of recycling their portfolio, meaning they've sold older vintage assets, purchased newer vintage assets. So we see a great internal growth from this REIT. Hopefully we can continue to see 5% internal rent growth, which means easily the stock should trade a couple dollars higher from where it is, just based on the income alone, let alone what we believe should be the right cap rate for the REIT. As I mentioned before, we think the private market has it right. We're seeing low 5% cap rates, even sub 5% cap rates in their markets, yet you can go buy this REIT today at a 6% cap rate on the TSX. So we think that mismatch doesn't make sense, and we think this is a great opportunity to buy a smaller, higher growth REIT.
Your next idea, Irish residential properties.
Yeah, so we thought we'd continue the theme of residential, but outside of Canada, just to give something else for your viewers. We really like IRES. They're focused on the Dublin market. They own about 3,800 units. That makes them the largest owner of multifamily units in Dublin. There's a severe housing shortage in that city. You think about Ireland, it's one of the winners of Brexit. It's the only native English-speaking country in the EU. Thus, we've seen it also as a tech hub, and so you see a lot of demand coming into that market, not a lot of supply of housing units, and so IRES has a nice mark-to-market in their rents. It trades at a big discount to its net asset value. It's currently trading about €1.40. We think it's easily worth €1.80, and has some upside from its development pipeline as well. So we think it's a nice company with nice growth and trading at a wide discount to net asset value.
And a similar theme, you're taking us over to the Netherlands now. Your next idea, European residential REIT.
Yeah, another play on housing shortage in Europe. What we like about the Netherlands, it's the most densely populated country in Europe. This REIT is, just like IRES actually, is externally managed by CAPREIT, Canadian Apartment REIT, and we think very highly of that management team, and they've done a great job of navigating both all three countries, quite frankly. And what we like about ERES is that throughout the pandemic, they have done a great job of keeping their buildings full and seeing very nice rent growth. They put in self-imposed limitations on rent growth, just simply out of inflation, about 2.6%. You're still going to see top-line growth of 3 to 4% in this REIT, despite what they were allowed based on rent control regulations, and they could have had another couple hundred basis points of upside. So trading at a wide discount to net asset value, easily worth north of $5, and you can buy that REIT today at a discount.
We'll have to leave it there. Andrew, thank you very much indeed.
Thanks for having me on.
Andrew Moffs of Vision Capital.